class. In this video, I am going to be walking through the journal entry portion of problem 2. We went through the calculation portion in class, and so here I am just walking through the journal entries that need to be made with respect to fixed overhead. So up above here and on the right, you see here the calculations that we did earlier. So we calculated the variable overhead costs, overhead spending variance, efficiency variance, fixed overhead, and production volume variance. All those formulas are on here. And we're going to need to use a bunch of these components for making our journal entries. So the first entry that they're asking us to make is to record our actual variable overhead costs that were incurred, which are highlighted over here. So these costs are like, hey, we got bills in the mail for these overhead items and or needed to record depreciation, etc. So variable overhead typically changes based on actual usage and is something that you are generally paying for. So we're going to be debiting variable overhead, and we are going to be crediting accounts payable here for the bills that we have to pay. So 474,500. And go ahead and save that. So now when you hit save, by the way, it's going to click you to the next entry here. So that was the first entry. Here's our second entry. The next entry that they want us to make is to record work in process. So, or to record the costs that are allocated essentially. So when we allocate these, right? So we make a journal entry to push these overhead costs into our work in process inventory so that they get costed out eventually as part of our inventory cost, right? Because these costs are all associated with producing whatever our product or service is. So we want to assign them to our cost of sales account. So here then, we need to look for the amount that we're allocating, which we calculated in a previous problem. We took the $20 budgeted rate per machine hour, and then we multiplied it times the standard number of machine hours that we expected to use. And by the way, that standard machine hours was calculated using the actual production level. So standard machine hours at production times, or standard units, standard quantity, times the variable overhead per unit. Okay, that's the amount that we allocate for our overhead. So we're going to debit work in process here, and we are going to credit variable overhead allocated. Okay, and it's just going to be for that $438,000. Okay, so that is the entry for variable overhead costs allocated. All right, now the next entry gets a little more complex because here's where we're going to start to incorporate some variances here. So here we are going to be looking at, so we allocated, right, in this previous entry, $438,000. We credited that to variable overhead. Now, ultimately, we want this allocation account to get zeroed out. Like this is a transitional account. But we're going to use this in an entry to record our variances. In particular, both our variable overhead efficiency variance and our variable overhead spending variance. And then we're going to use that to zero out the variable overhead account that we had here, right? Because ultimately what's going on here is we record these accounts payable. This gets pushed into variable overhead. We move it out of variable overhead and into an allocation and a variance account, okay? So going back here, we had allocated overhead of $438,000. So we credited that in our previous entry, and we're going to debit it here to zero that out. So variable overhead allocated gets debited for the amount that we put in there originally. And then the next thing that we need to do, so we're debiting that account, and then we're going to be crediting our variable overhead account. But we need to take a look at our variances here first, right? So as part of this entry, we're going to be including our variable overhead efficiency and spending variances. So one of those was favorable and one of those was unfavorable. The 146,001 was unfavorable. So variances, the journal entries for variances get treated kind of like expenses and revenues. So unfavorable would be kind of like an expense, right? So we're going to debit that one. Okay. So I'm doing that one next because it's a debit, because you have to do all of your debit lines first, and then you have to do your credit lines after in terms of when you're making your journal entry. So this is our variable overhead efficiency variance. And then we'll go ahead. We know this other variance is going the other direction for 109,000. So we'll go ahead and do that one next. So this is going to be our variable overhead spending variance. There it is. So that one's going to get credited. So just like a revenue is favorable, a favorable variance would also get credited here. And then the other account that we are crediting here is we were moving this, remember, out of our variable overhead account. So that's what we're crediting here then. So when we recorded our actual overhead into that variable overhead account, it was 474,500. Okay. All right, so that is our journal entry for recording the variable overhead variances, okay? So if you do your variable overhead allocation number, right, in your first line, and you do your variable overhead that you're cleaning out on your last line, then you can do your two variances in the middle and just check to see whether those are debits or credits in order to make sure you get them in the right column here. Okay, so whether they're favorable versus unfavorable determines that. All right, so then notice then, all right, so we recorded this into our variable overhead spending variance. We have a debit there and we have a credit in our overhead spending variance account. Now, these are just tracking accounts that we use interim so that we can look in there and so we could do a whole bunch of different mini entries if we were doing this in real life. Like say we're doing this related to one division or one particular type of product, and we wanted to look at overall for all of our products, they would all be grouped together in these accounts. And then we could say, hey, overall, our overhead efficiency variance as a company was, a certain amount. Now here we just have one product, so we have one entry here. But ultimately, we don't want these numbers sitting out here forever and just building up. So we zero these out into our cost of goods sold at the end of the day, which is where the cost of all of the other inventory ends up. So basically, because what we put in our work in process, let me just save this one here quick. What we put in our work in process here was only the amount that we allocated. It wasn't the actual amount of the expense. So this work in process will eventually go into finished goods inventory. And then when it gets sold, it'll get pushed into cost of goods sold. But we don't want only the amount we allocated to end up in our cost of goods sold. Ultimately, we want what we actually paid to end up in there. So we have to make sure that those numbers get pushed in there. So if we look here, right? The difference between our actual overhead that we paid and what we allocated is 36,500. That's also the difference between these two variances, which are in opposite directions here. So we need to figure out how to make our amount that's going to flow through to cost of goods sold equal this actual amount that we paid. So this last journal entry then cleans up our variance accounts and empties them out. And then the difference between these variances ends up going to cost of goods sold. So here, because we are going to be zeroing these out, right? We originally for these, we debited 146 and we credited 109. So we need to do the opposite to zero those accounts out at the end of the day. So like at the end of our reporting period. So we're going to go ahead and put the variable overhead spending variance first here. And we are going to put our variable overhead efficiency variance here. And then, so that one was the 146,000, and this one, 109,500. So we credited this account originally. Now we're debiting it to zero it out. And then this one we debited originally. So now we're crediting it to move it out. Now to make this entry balance, we're going to end up needing to debit cost of goods sold for that difference of 36,500. Okay. So that's all we had to do for these entries, right? So we have a process going on that starts with recording all of these expenses when they are paid, crediting them to accounts payable, and then plugging them into this variable overhead account. And then we are going to allocate overhead out by crediting variable overhead allocated, debiting into work in process. But then because we've got a difference between what we put into variable overhead and what was allocated, in this entry, we reconcile that by recording those two variances. And then in the final one, at the end of the period, when we no longer need to know this period's variances anymore, we zero those out, and whatever the difference is washes into cost of goods sold. So it is possible you could be making a credit entry to cost of goods sold depending on what numbers you have in these two accounts. So it's not always a debit to cost of goods sold. So I just wanted to call that out there. All right. So that is it then for those entries. And so then when you're done, it should look something like this. All right. So that is it for the journal entries. We will continue doing some more examples of this in class during our next class session. Oh, actually, no, I'm sorry. I've got one more set of entries here. Haha, just kidding. Okay. Okay, so for our fixed overhead entries, we have kind of a similar process here. So we're going to record our actual fixed overhead, which we've got here, and I didn't highlight it yet, but I'll do it right now. So what we actually paid in fixed overhead, which they provided to us, was $600,000. So just like we did debited variable overhead in the last one, we're going to debit, oops, got to return to my problem here. There we go. We're going to record a debit to fixed overhead here. Okay. So we're debiting fixed overhead for the $600,000. And then I don't love how they put this in here, but basically like what you'd be crediting here would be whatever the expense accounts were for what you're paying. So if we scroll over here and just look at our overhead, right? Our mix of things like if we were doing a detailed journal entry, which unfortunately they're not having us do, I would have preferred to do it that way. We would be crediting like rent payable, utilities payable, taxes payable, etc., salaries payable for the total of that, or for those different accounts, right? So this is a budgeted amount, so it doesn't tie out to the 600,000, but they didn't provide us the detail of what we actually paid on these line item levels. So we're just taking and we're using a plug account here, which is salaries, etc., salaries payable, etc. So that's the first entry to record the actual overhead, okay? So then once we do that, next, just like in the last one, we're going to record our allocation. So we're going to debit what we allocated into work in process here, right? And then, so what we are using for that allocated number is this applied fixed overhead here. So that 573,050. And that's going to be credited out of fixed overhead allocated to just record that allocation. Okay, so just like we did in the last one. The last one we debited work in process and credited variable overhead allocated. This one it's the fixed asset equivalent, so we're doing fixed overhead allocated. Okay, so for the third entry then, just like in our last one, we're going to be zeroing out our fixed overhead account, zeroing out our fixed overhead allocated account. So if you remember, we credited this one, so we're going to debit it to zero it out. So fixed overhead allocated, and that was for 573,050. And then we're going to have our two variances in here, right? We're going to have a fixed overhead spending variance, and then we're going to have a production volume variance here. And those are the two we're recording. And then so our fixed overhead spending variance was unfavorable. So that's going to be treated like it's an expense, right? So if it's unfavorable, then it ends up getting debited. So we're just putting those amounts that we calculated earlier. Whoops, 11,000, not 10. And then this one, again, production volume variance is also unfavorable, so it's also going to be debit there. And then, as I mentioned, the last one is the fixed overhead that we recorded in the first part there. So that was $600,000, and that gets credited. And that should get you to, so the difference between your actual and your allocated amount, right, is the overall total fixed overhead variance, okay? So we'll save that. And then for our last entry, just like before, we're going to be zeroing out these two. So these are both debited, so they'll both end up getting credited here, which means that we'll have a debit to cost of goods sold, and then we'll be crediting those two variance accounts. So fixed overhead spending and production volume variance for their respective amounts. So 15,950. Oops, I'm putting on the wrong line here. Hold on. There we go. 15,950 and 11,000. Those two combined gets us to 26,950. So that is the way we do those journal entries. So they're both very similar. So if you learn one, you kind of know both of them. All right, the big difference was that in the variable overhead, everything went to accounts payable in that first entry, whereas in the fixed overhead, we probably have a variety of different types of payable accounts like salaries payable, taxes payable, etc., that would be getting credited instead. So that is it for the journal entries part. And as I started to say before, we will look at some more examples of these in our next class session. Please let me know if you have any questions.